Before Juan and Tim Congdon present their paper, we have Lars Christensen. Lars has a master's degree in economics from the University of Copenhagen and worked initially as an economic policy analyst at the Danish Ministry of Economic Affairs and also head of emerging markets research at Danske Bank, Copenhagen. But he's become an internationally renowned economist, really more because of what's happened in the last 20 years. He's the founder and owner of Markets and Money Advisory, also senior lecturer at the Centre for Corporate Government at the Copenhagen Business School, and he is the founder and editor of an excellent blog in monetary economics called The Market Monetarist. He will be presenting his paper first, but since Peter set the ball rolling by introducing all the speakers up front, I will also introduce Tim Congdon, who started his career as a journalist on The Times before becoming an economist in the City of London in the 70s, but probably more famously set up Lombard Street Research in 1989. He also, during the 80s and 90s, advised the Conservative government on economic policy as one of the so-called wise men, and has come to be regarded as the UK's leading exponent of the monetarist school of economics. He's also published fairly profusely. In 2005, he published Money and Asset Prices and Boom and Bust. In 2009, Central Banking in a Free Society, which is a critique of the Bank of England's response to the Northern Rock affair. He also published a collection of essays on Keynes, the Keynesians and monetarism in 2007, and another book with the title Money in a Free Society was published in 2011. He set up International Monetary Research in 2009 as its initial director, but he handed over that directorship to Dr. Juan Castaneda, who is now the chairman, Tim is now the chairman of the Institute. So Juan Castaneda, he has been basically a doctor of economics since all the way back in 2003. He achieved his doctorate at the University of Madrid and then continued to work there for 14 years as a lecturer in economics before moving to be a lecturer in economics at the University of Buckingham, which he's been doing since 2012. He's released a new book, co-edited with Geoffrey Wood and Alessandro Rosselli, The Economics of Monetary Unions, Past Experience in the Eurozone. And he has, since September 18, also been a member of the Institute of Economic Affairs Shadow Monetary Policy Committee. So it should be very exciting to listen to both of them talk, but we kick it off with Lars Christensen. Lars.
Thank you, James. First of all, thank you for the invitation to speak here today. We are certainly in interesting and challenging times. I will be talking about whether this crisis is inflationary or deflationary. I can already reveal I will come to the somewhat boring conclusion. It will be neither. But before I start, I think I would like to just say a little bit about the two previous presentations, or maybe raise a question that we can come back to in future seminars. Because one thing that I noted was we had one presentation on demographics and we had another presentation on money, but we didn't have a presentations on the relationship between money, particularly money demand, and demographics. And that's a topic I spent quite a bit of time working on. So maybe we could return to that later on, but I think that is a backdrop of the story here. Rather than taking a long-term perspective, I will in this presentation look specifically on what's going on in 2020 and what I believe is the most likely outlook going forward in terms of the present crisis. But if we can go to skip the two first slides and go to slide 3. Next slide, please. Yes. So this is really easy, isn't it? Hardly any of the panelists here, I think, disagree on Milton Friedman's words. Inflation is always and ever a monetary phenomenon. However, I do think that we, to some extent, disagree on whether inflation is a monetary aggregate phenomenon or whether it's a broader than that. And I think that really becomes the question whether we should just focus on monetary aggregates or whether we should focus on something broader than monetary aggregate. But so let's look at it further. Next slide, please. So obviously, again, it's about the equation of exchange. I think anybody who studies economics should at least once a day write down the equation of exchange, just to keep on reminding yourself about the importance of this. Obviously, when we talk about inflation versus deflation, this is what we have. Money determines inflation, it determines nominal demand, nominal income in the economy. But money is also determined, or this is also a relationship between the money supply, or aggregate money, and the demand for money and the velocity of money. So if we can go to the next slide, please. I think a way to, next slide, please. Yeah, a simple way that I like to engage students when I talk about this is essentially to present this graph here. What we have is a central bank and a private sector that in total controls the money supply. And we have money demand, and that can be determined by numerous factors, some short-term, some long-term. But there is a relationship between the two that determines nominal spending in the economy. And I think that that's essentially the easiest way to understand whether we are going to have inflation or not, is to have a discussion about what determines money supply and what determines money demand, and how do these play together to determine nominal spending and hence inflation in the economy. So next slide, please. So if we can sum it up, money supply growth is the key determinant of nominal spending and hence inflation. But we cannot understand nominal spending and inflation without also understanding the dynamics of money demand. We cannot ignore money demand shifting back and forth. Whether there's a stable relationship between monetary aggregates and nominal spending is another discussion. But there is a money demand side to this we need to be aware of as well. And I think one thing we often forget when we talk about money demand or talk about money in general is to what extent the monetary policy regime matters. We have had Charles Goodhart on. Goodhart's law apply. Goodhart's law apply exactly because when we look at history, monetary regimes are not the same all along. Monetary regimes, to a very large extent, determines the money demand dynamics. Please, next slide, please. So another issue that I think is very important is the importance of expectations and how we can read expectations essentially from financial markets indicators. As some of the viewers and participants know, I coined the phrase market monetarism as to say that monetarism is necessarily not enough, that we need to understand money also by looking not only at monetary aggregates, but also to looking at expectations as they are reflected in market pricing. So I do think that other than monetary aggregates, markets provide deep insight into expectations and hence about the future expectations on the path of monetary aggregates. It's textbook that is the permanent changes in monetary aggregates that have impact on nominal demand, on nominal spending, and on inflation, not temporary changes. So this is quite important, and markets is telling us whether markets perceive a change in the money base or in the monetary aggregates as permanent or temporary. So I think that market prices, stock prices, currency prices, the yield curve, etc., is telling us something about the market's perception or expectations about future growth in monetary aggregate, monetary base, and so forth. Next slide, please. So I'll try to illustrate that. So if you go back to the equation of exchange, I believe it's a good way to think about a benchmark about when do we see monetary aggregate develop in a way such that they are whether they are inflationary or deflationary. So first, let's start ignoring what market prices are telling us. So what I've done here is essentially to calculate a M2 target. The reason I do that is it fits very nicely both with Eurozone data and with the US data. If we look at M2 and we say that both in the US and in the Eurozone, the inflation target is 2%, then we can, by looking at the trend growth underlying in real GDP, underlying productivity, plus a trend in money velocity, we can calculate what kind of money supply growth that we would need to have to ensure 2% inflation cycle, or 2% inflation in the medium term. This is essentially what the old reference value of the ECB was calculated. So luckily, if you look at the trends in M2 growth over the past 20 years in the US, money velocity has declined by more or less 2%. Inflation target is 2%, and real GDP growth more or less is 2%. That gives us a M2 target of 6%. However, we can also, if you go to the next slide, calculate going backward. If we look at what I've done is this is just to look at the first to see the trend in money velocity. You can see it has been trending down since the late 90s, around 2% a year. You can see a very sharp dip in money velocity in 2008-9, and similar very sharp drop in money velocity right now. But the underlying trend is that around 2% decline annually or the medium term in M2 velocity in the US. A very similar pattern in the US. Go to, or in the Eurozone. The next slide, please. So if we look here at actual money supply growth, what I've done here is I calculated an implied medium-term inflation. Is generally saying, if we say that we have the 2% trend in money velocity, and we have the 2% trend in real GDP, what inflation, medium-term inflation target or growth estimate would that generate? Here I have used the Congressional Budget Office measure for potential GDP rather than a 2%, and I think I looked at 10% trend growth in a 10-year moving average growth in money velocity. So I calculate that, and you can see, of course, here that one thing that is notable is that we have been, since the past 20 years, we have been having an average around 2.5%, but it has been down to 0 and up to 5 until the recent event. If we then look at what the market is telling us, you can see that 10-year bond market inflation expectations, as calculated, if you just look at so-called TIPS, inflation-linked bonds, we can calculate what the market is expecting about inflation in the coming 10 years. You will see that has also more or less been around the 2.5% mark, at least prior to 2008. It has been trending downwards since 2013 or so, but still remained fairly well anchored. And you can see that the two graphs are essentially having the same average over the medium term. But you can also see here something interesting is that it is our monetary aggregate forecast, which is essentially converging toward inflation expectation and not the other way around. So it seems to be that the market is determining broad money. I would suggest that is in fact what is happening, that to some extent broad money is driven by demand side factors. Think about the world in the following way. If the money supply is growing faster, that what would ensure 2% inflation, market participants would expect a credible central bank to slow money demand growth or slow money supply growth. So what would these actors do? They would actually demand money. because they would expect the value of money to go up if policy is credible. And this is exactly what we see in velocity, is that during credible monetary regimes or inflation targeting regime, the money velocity moves up and down to ensure the inflation target, rather than being the money supply in itself is moving up and down. But obviously something has happened since the onset of the present crisis, and money supply growth has skyrocketed. And of course, that translates into something like 20% inflation, quote unquote, if we're just going backwards and using the equation of exchange. So one thing that is, of course, is puzzling is that if that was the case, we would have the clash of two University of Chicago ideas. On the one hand, we have Milton Friedman's view that if you have very high sustained growth in the money supply, you would have inflation. On the other hand, we have Gene Farmer's efficient market hypothesis. If the market tells you that inflation expectations are 2%, there is a conflict here. Essentially, if you believe that we are going to have inflation now, there is money in the street. The efficient market hypothesis would have to be wrong. You would have to go out and sell bonds and sell the dollar now aggressively. And if you don't do that, then it's because you don't believe in the market. So here we have a clash of essentially two Chicago school ideas: the efficient market hypothesis and inflation is always and everywhere monetary phenomenon. How can we reconcile these two things? There's only one way to reconcile these two things, and that is that the growth rate we have seen this year in broad money does not reflect permanent higher money growth. And it does not reflect a constant level of money demand. If we take a look at these two things, then we can reconcile it with market pricing. So next slide, please. So, and this is of course also what we see. If you look at money velocity, it has dropped very sharply. In fact, money velocity has dropped more sharply than it did in 2008 and 2009. One thing that I, however, find interesting about the contraction in, or the drop in money velocity, is that there is an indication that something really is not a sustained drop in money velocity. The increase in money demand, in dollar demand, is not permanent. Why? How can I see that? Well, if you look at the stock market, global stock markets have essentially returned, although as we are speaking, they drop rather sharply. But US stock market is now higher than it was prior to this crisis hitting. The dollar hasn't moved much. As I said, inflation expectations are essentially unmoved. So the markets are telling us that this drop in money velocity might be of a temporary nature. I have again and again over the last couple of months been saying that this crisis really isn't a recession. To have a recession, you need to have a sustained shock to the relationship between money demand and money supply. What I believe this is more akin to unplanned, very long and very bad vacation. This is essentially a supply shock. We stop producing for a period and we stop consuming at the same time, by the way. Imagine you go on vacation in August. That's what the French would do. You go on vacation in August, but you don't spend.
You're on the last minute, if that's okay.
Yes.
Thanks.
So this is essentially what I think is happening, is that this crisis is essentially not a recession. It's just a very bad vacation. But once we return from vacation, everything will return to where we were before. If you go to the next slide, just to show. One more slide, please. So I think one thing is important in terms of the growth of broad money in the US. On the left, you have the level of broad money you can see that that move, that's a red line, moves completely with deposits. Deposits have increased, but interestingly enough, if we look at a proxy for nominal demand, private consumption expenditure, that has declined, even though it's returning now. So this is driven by the transfer of money from the US government essentially to households, and by the fact that households have stopped consuming. But they will return consuming and deposits will decline as a consequence. But if you look at the graph on the right, you will also see this is a 3 months annualized growth rate of deposits. We had a sharp increase in deposit growth, but if you go back, we essentially have had no deposit growth for the past 4 months. There is no deposit growth in the US. If you look at this graph, would you say, okay, what would you forecast money supply growth to be over the next 5 years? Would you forecast it to be 0 or 20%? And judging on this, it's probably closer to 0 than to 20. So from that in itself, they also say that's why markets do not expect inflation to go up markedly. Next slide, please. Yeah, you can see it here. I'll end it here. But next slide, please, and then we can end it here. This is again inflation expectations. You see both 10-year break-even inflation rate from the US bond market and 5-year forward inflation expectations. So that's essentially where do markets expect inflation to be from 2025 to 2030. You can see there was a sharp contraction initially. The Federal Reserve responded. Probably markets also reacted and saying maybe this is not the end of the world. Money demand probably adjusted, and you have seen inflation expectations coming back. But essentially now inflation expectations are exactly where we started. So my view is essentially that, well, nothing happened. This was a very long, unplanned, extremely expensive, bad vacation. But I have no indication that the underlying monetary policy regime has changed with all its faults. So essentially nothing had happened compared to, let's say, January. And in January, I would expect the Fed to deliver 1.8% inflation for the next decade, because that was what the market was telling me. Gene Farmer and Milton Friedman can't be right at the same time. Thank you very much.